The key with income taxes are really the tea leaves for your financial plan. There's a lot of things that are indicated on your taxes, doing a proper review of your income taxes that affect everything else. Income taxes is usually your biggest expense in retirement, and that's also where your biggest opportunity lies, in managing income taxes, not overpaying income taxes. Here's the tax brackets. You want to know how many of you think you know what tax bracket you're in before you're even looking at this? That's a good question. So you should always know what tax bracket you're in. So I'm going to show you that again, but here's an assignment. Line 43, it used to be line 43, then is line 10, now is line 11B. It's your taxable income. Here's your assignment. What is your taxable income? What was it for 2019? What was it for 2018? And what was it for 2017? And what we're looking for is income tax cost consistency. Staying in the same tax bracket year over year will save you money on income taxes. It will, because of marginal tax brackets. You can see it goes 10, 12, 22, 24. The jump between 12 and 24, as I will show you, is almost double the amount of taxes. So improving your tax efficiency, and then the next thing to write down is time for evaluation after Thanksgiving. After Thanksgiving. Each year after Thanksgiving, it's in your best interest to be projecting your income tax costs for the current year. Because after December 31st, other than IRA or Roth contribution, there's nothing you can do to control your income taxes after December 31st. So the time to do tax planning is before the end of the year. And then required distributions. What happens if you're going to be forced or currently are forced to take required distributions and you don't need the money? What are your options? And then we'll talk about the qualified charitable deduction. So the key here that we're talking about is the difference between tax preparation and tax planning. Paying your taxes on purpose and not accidentally paying any income taxes that you don't need to pay. You want to write this down. If you're in the 12% tax bracket, you pay 0 long-term capital gains. No long-term capital gains if you're in the 12% tax bracket. That's a big deal. A lot of CPAs are not even necessarily aware of this one. Required minimum distribution. This is the required minimum distribution schedule. Suffice it to say, if you haven't started taking out your required minimum distributions yet, when you turn 72 now, you have to start taking out around 4%, and in each year it goes up just a little bit. You have to take that money out, you have to pay the taxes. So as an example, if you have $1 million in your IRA or your company savings plan, you would have to take out around $40,000. So that $40,000 would be added to your taxable income. And depending on what tax bracket you're in, is how much extra that $40,000 is going to cost you. Here are some credits that Mr. Burkle is much more familiar with, some ways that you can save money on your income taxes, and he can tell you better if those are things that you may qualify for or qualify for more than what you're currently qualifying for. And here are income tax bonus penalties, depending on how you're taking money out of your accounts. You may trigger additional tax, and we're going to go through these areas of additional tax briefly. You want to write this down: phantom gains. If you have mutual funds, when they rebalance, which is what they normally do, always do, each year, it may trigger some capital gains, short and long-term capital gains, that cause you to have to pay extra tax on your Social Security. So that's another big deal of adding to your Social Security income tax. Deciding whether or not your Social Security is taxed is determined by your ordinary income, dividends and capital gains, and non-taxable interest. You're going to want to write this down. An example of non-taxable interest is municipal bonds. The big attraction to municipal bonds is there's no federal income tax. But a lot of people are not aware that that income that they're receiving for the municipal bonds adds to the calculation to determine if your Social Security is going to be taxed. So you could have a municipal bond that's paying 3.2%, But after your Social Security extra tax is being triggered, you're only getting maybe 1.7% or something like that on that municipal bond because it's triggering other taxes.